Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis. Gosh, to say another edition, but first one in 2022. Took some time off for the holidays last year, so excited to be back with it as always. If you find the video intriguing, you find it interesting, be sure to hit that subscribe button below so you're notified about our future videos. But as always, want to take a look at a prominent stock. Also, kind of talk a little bit about what's going on right now in the financial markets. It's as always, it's dynamic. It's always changing. So, with that, I think we're going to talk about thoughts about investing in 2022. Hit some items of the job report that came out today, and also talk a little bit about tech stocks and one tech stock in particular.
Yeah, and Chase, today is the first Friday of the year, first Friday after the month, which shows the jobs report comes out this morning, which it did. Looked disappointing, but was not as bad as maybe it's made up to be. Still gained 199,000 jobs, I think it was. They missed the estimate by a wide margin, but there's other factors. You look underneath the numbers that, well, it's not quite as bad as we thought it would be. We did see unemployment fall somewhat. We do have some other concerns on participation rate, but it's nothing to really be concerned about at this point. And again, we got to remember that we had a increase in COVID at the end of December, which could have changed things on the job market as well.
Yeah, and the big thing that I kind of want to relate the jobs market to the big discussion today, and that's investing in 2022. I think you're going to be ripe for inflation, rising interest rates, which is going to really hammer the growth stocks, your tech stocks. And the reason I'm bringing up the inflation part is what we did see in this last job report was a nice wage inflation. Gosh, I think it was like 4.6% is what we saw on the average hourly earnings increase. And the big problem is you brought up the labor force participation rate. I'm worried that we're running out of workers. And the only way to kind of resolve that problem is increasing wages. Well, with increasing wages, I think we're still going to have a runway here for increasing inflation for the consumer, for the producers, and wage inflation generally can set the stage for that. So that's why I'm still concerned about inflation. That's why I think we'll see interest rates continue to rise. I wouldn't be surprised to see, gosh, the 10-year note at 2% here soon, maybe 2.25% by the end of the year.
And also, do Chase, I mean, inflation is a factor, and I say this all the time for people. It's a very simple problem. Too much money chasing too few goods. You give people raises, you get more people in there. They got more money to spend money on. We got money coming from the government, and then you have the problem of supply chain issue being a problem. Well, that's just going to push prices up. So that will make interest rates rise more. So it is this circle we're on. I know we're going to talk about 2022. The good thing I see is that for the first 6 months of the year, I think is going to be a problem. Not as bad the second 6 months, but you got to know where to invest because there's going to be some surprises. I think this year, you kind of hit it on it, was the growth stocks. I think it'll be a very difficult year for growth stocks in 2022.
Yeah, I mean, and people just got to realize that there is a end to things just going up endlessly. I mean, it just it can't keep going up and up and up. I mean, I talked about Microsoft and Apple here on Fox 5 this past week, and I mean, it's shocking to me that Apple's up 140%, Microsoft's up 100% over just the last 2 years.
Yeah.
What do you think is going to happen? That's going to go up another 140%? I just don't foresee that happening. I mean, there's just not enough money, in my opinion, to keep those stock prices climbing at that rate. And I think people are going to be shocked to see big tech really not do much. And kind of speaking of that, is last year you saw Amazon trade sideways. I think you're going to see a lot of that in your big tech stocks this year. I don't think you're going to see massive declines by any means. And it could happen, but I think more likely is going to be a plateauing effect.
And you say last year Amazon traded sideways. I think it was up maybe what, 5%, maybe.
Yes,
It lost that 5% gain so far in 2022. I've not looked at it, but it could be.
I think that's very real possibility. So I just kind of want to set the stage for 2022. I don't think what's worked over the last decade is going to work this year. I would not be surprised to see a return to value, and especially I'll let people know the stock we're looking at today is Nvidia, a big tech stock, and it's stocks like these that just scare the heck out of me. And I haven't looked at the numbers, but I do know that it's an expensive company. And it's a stock like this that I think people are going to be like, what? How did that happen? It was Nvidia, and it's going to be a blindside effect for people that especially have done so well with the stock.
And I don't know when you want to bring up these numbers, but before, and we kind of talked about NVIDIA before we chose it. I think you said it was I might give this away a little bit, the seventh largest company now. Was that the number you said?
Yeah, it's the seventh largest company now in the S&P 500.
And I think you said, well, we're kind of giving them part of the thing away, but their profits, we'll say this, are not as large as Intel, which is nowhere near the seventh largest company.
Yeah, and I mean it's got a market cap now of about a 708 billion, and Intel's at about 200-ish billion. I say 200-ish. I think it's like 250 or somewhere in that range, but nowhere near the size of Nvidia. And people just need to realize that what is Nvidia going to do? Be 20 times the size of Intel? And you might be right. Maybe Nvidia will be a better company than Intel in 5 years. But that's already priced in the stock if it's 3 times the size of Intel, It,
No.
it just it doesn't make sense. And especially, gosh, I look at the return numbers on Nvidia. Over the last 5 years, it's up 1,000% or 993% to be exact. Over the last 10 years, up 7,700% about. I mean, it just can't keep going up and up and up. And we've been wrong on Nvidia, I'll tell you, for the last 2, 3 years. But at some point, it can't keep going to the moon.
Right. And I've seen this happen before. And people, if you made that type of return, congratulations, but don't think you'll make that same return this year, 5 years, 10 years down the road. If you look at any company that's done what NVIDIA has or many of these other high flyers, you will see eventually they peak out, and the downside, because everything goes back to the mean, is very, very painful. I saw a guy the other day, and yeah, at one point I had $1 million. Well, now I got 170,000. You start doing things that you shouldn't be doing, and your gains dissipate. That's why we do the YouTube videos here, to show you what we're looking at and how to get back to the fundamentals of investing, which work very well long term. Short term, you can throw darts at the board, sometimes do better.
Yeah, and especially with companies like this, I mean, it's, as you said, congratulations if you've done well on it, but when are you going to get out of it? If it goes down 50, 60%, which could happen, you wipe out all those gains you've had, not feeling so hot about that. So,
Yeah.
and you think we're crazy here, but I'll show you why. Let's take a look at the numbers for Nvidia, and you'll kind of see why things don't really add up for the stock.
Yep. All right, where are they? There we are. Okay, so there's Nvidia, symbol NVDA. Nobody's taking a short position on this, only 1%. I'm surprised here, 67% institutional owned. That's I thought it was gonna be larger. Last reporting period was October 31st. So the next one, we won't see any numbers on this probably till late February. Let's get into the valuations here. Wow, look at that PE, 84.1 versus the industry at 30.6. And they are in the industry of obviously technology, chip stocks probably. Just to let you know, that means that it takes 84 years to get back what you paid for this company based on the earnings. It's just a crazy number. The average over the last 100 years for earnings, or the PE ratio, is about 14 to 17. So trying to put things in perspective. No better on the price of sales, 28.4 versus 6.8. Book value, let's look at the tangible book value, 40 versus 100 plus. A lot of technology companies don't have a lot of tangible assets, more intangible assets, causing that strange number there. Price of cash flow, 84 versus 18.5. That's just crazy. Now, this is kind of crazy as well. This PEG ratio, 1.6 versus 6.2. I'm surprised that's so low. I think a lot of people are overestimating what the earnings could be on this company going forward. But let's look at the past year, what they have done, because they have done a good job on their earnings per share, 1 year growth, 112%, more than double the industry of 43%. Earnings per share last 5 years have grown by 46%, again above the industry at 26.7. And look at the sales growth here, 1 year 64% versus 5, and even 5-year growth 31.6 versus 3.4. And we got to point out with numbers, a lot of times that 31% can be because of the last 2 years they did a lot, which increases that 5-year growth rate. So really understand your numbers. The analysts are seeing good things again going forward. 5-year 39.4 versus 20.9%. Wow. Now, why are they doing this here? Why are they paying a 0.1% dividend? I mean, that's just pitiful. I mean, we don't have time to look at it, but I would love to look at the balance sheet to see how much cash they have. They should increase that dividend. Just kind of crazy. What is the actual dividend number? 16 cents. What's the stock? Well, you're going to share that in a minute. Looking at the balance sheet here, we do see a current ratio of 7.1 versus 3.6. A lot of liquidity there. Again, showing they could increase that dividend if they wanted to. Debt to equity looking good, 0.5 versus 0.6. No debt problem. Even intangible assets low on the balance sheet, 16.6 versus 22.4. Looking at the days sales outstanding, not quite as good, 59.3 versus 50, and you want a lower number here. Looking at the net profit margin, that is a good number, 33.8 versus 29.9. Return on equity is very good also, 34.5 versus 27.2. So the numbers are looking okay, but I think they got other things to look at. So I'm going to turn it over to you, Chase. Look at some other numbers here for us.
Yeah, of course. So the current price for Nvidia, $272.47. You see the 52-week high right here, $346.47. And the 52-week low, $115.67. So it had, again, a great 2021. I see year to date, though, it's down about 7%. I wouldn't be surprised to see the struggles continue for this company, though, especially as rates continue to rise. Now, going forward, though, I want to see what the company is estimated to make. We'll go out to January 2023. You can see the company is estimated to make $5.18. Again, if we use our 16.6 multiple for that, we get a laughable target sell price here of $85.99. And it just shows, I mean, the company's trading at 52.6 times forward earnings. It's just so expensive. And the big thing that people need to understand is there's a huge difference between a good company and a good stock. And what I mean by that is Nvidia. I'm not saying it's a bad company. I think the CEO's done a great job. I think they do have a lot of room for growth, but that's all baked into the stock price. You can't trade at a multiple of over 50 times for a long period of time. It just doesn't make any sense.
Yeah, and Chase, I think a lot of people don't understand the difference because we're saying this is a great company. There's a lot of great growth companies out there, but the thing is, they're just too expensive. It's like going to Vegas. You can win and win and win. Eventually, you stay at the table too long. Same thing with these companies, and maybe you don't hit the absolute top. And that's the thing too. People try to get the absolute top. You will never ever get that absolute top unless you're lucky. So be careful. You might have some gains there. Maybe get rid of them, or at least pare them back, do something, because it's going to be a very difficult year, we believe, on growth companies, because as interest rates rise, your growth stocks do not do as well. Check that out in history for yourself. Don't take our word for it, but that's the way it works.
I want to kind of let people know too, the reason for that is you're looking at the future earnings. Well, as the interest rates rise, those future earnings, those future cash flows actually become less attractive. So that's why the interest rates are having such a big impact on these growth stocks, because of the expectations for those future earnings and what they're worth in today's dollars if you discount them. So again, as I said, be cautious with it. But again, if you found this video helpful, I hope you enjoyed our Smart Investing weekly stock analysis. Just as a reminder, it is for informational purposes. But again, be sure to subscribe to our videos, our Smart Investing with Brent and Chase Wilson YouTube channel, so you are notified. Thanks again, and we'll see you here next week.